Hi, good morning, everyone, and thank you so much for joining us here at our iFast Mid-Year Review 2022. So my name is Wei Ren. I'm part of the research team at iFast, and today my presentation is on one particular market that has captured the attention of global investors for the past 1 to 2 years, and that market is China. So we think that now is a good time for investors to consider investing in the Chinese equity market. And in my slides today, I will actually be sharing with everyone the reasons why we have recently turned positive on the prospects of Chinese equities. So next slide. So we have always been positive on Chinese equities if you have been following our investment views. So over the past 1 to 2 years, we have expressed a certain level of positivity over the performance of Chinese equities. But admittedly, our expectations, our convictions have not worked out as expected because as you can see from the table, this chart on this slide, China has been the worst performing major equity market since 2021. Last year, we were caught off guard by the unexpectedly harsh crackdowns on the Chinese tech companies. And then for this year, Chinese equities continued its underperformance for the most part of this year, largely because of reasons that are largely quite well known by now. So we have got reasons like the COVID-19 lockdowns in China. There is still the uncertainty over the regulation and the environment over there in China. And of course, earlier this year, there was also concerns that China could potentially come under sanctions because of its relationship with Russia. So a confluence of factors have actually contributed to this sell-off in Chinese equities over the past 1 to 2 years. But despite these obvious risks, we think that now is the time for investors to consider entering into the Chinese stock market. And the first reason why we have turned positive, on the next slide, the first reason is because of our expectations that the Chinese government is going to implement more aggressive policy actions to stabilize the economy. So as of now, China's economy is facing a lot of downward pressures. And a lot of that is actually coming from the zero COVID policy that has so far been coming at a huge economic cost to China. And it is perhaps not surprising that a lot of economists, they have been downgrading their estimates for GDP for China this year. And a lot of them are not expecting China to achieve their official GDP target of 5.5%. In fact, if you look at the consensus estimate right now, economists are generally expecting China to hit 4.5% GDP growth for this year, which is well below the 5.5% official government target. Now, we acknowledge that it has become increasingly challenging for China to achieve this 5.5% GDP growth target. But having said that, I just want to say also that this target, it still remains achievable with the help of more stimulus measures. And we are expecting China to roll out more aggressive stimulus measures in order to support the economy. And they actually have been rolling out economic support measures, and they have also been aggressively fighting back against plummeting confidence in recent months. And as you can see very clearly from this table over here, the government has been rolling out new measures almost on a monthly basis. So on a year-to-date basis, there are a lot of things that the government has done, including rate cards. They have also been giving out tax reliefs, and they have also been issuing special bonds for infrastructure investment. And in the month of May alone, there has been a series of policy measures that are being introduced by the government. So I'd like to bring everyone's attention to a couple of them. So the first of which is the cutting of the lower bound range of mortgage interest rates for first-time home buyers. This is significant because this is the first time ever in China's property crisis that the central government has directly intervened in the property market. And just a few days later, the central bank lowered the 5-year loan prime rate. So the 5-year loan prime rate is the standard benchmark for mortgage loans in China. And this reduction was by 15 basis points. So this 15 basis points is actually the biggest cut ever. So it is a very clear signal to us that the government is very intent on supporting the housing market. It is very intent on reversing some of the damage that it has done to its housing market over the past 1 to 2 years. And also, it doesn't stop there. They have also been giving a new round of tax reliefs, and on top of that, they have brought forward the deadline for special bond issuance. So if you look at this table, in March, the Chinese government actually announced the issuance of special bonds for infrastructure investment. And the initial deadline for the local governments to finish this issuance is actually by September. But in May, the government decided to just bring forward this deadline by a few months to June. And they have also stipulated to local government officials that you must finish spending the proceeds by August. So they have been doing a lot of things this year to try to rescue the economy. And also on the next slide, besides just policy intervention is not the only thing that the Chinese government has been doing. The Chinese government has also been actively engaging in what I call verbal intervention. They have basically been saying a lot of things that signal their intention and signal their desire to want to stabilize China's economy. And I do have a couple of examples here on this slide. So in March, the government said that they will ensure stability in capital markets, support overseas stock listings, resolve risks around the property developers, and to complete the crackdown on the internet sector as soon as possible. And then in April, the government also said again it will step up policy support for the economy. And in that same meeting, the government mentioned again that they will normalize regulation. And this time around, instead of saying that they will complete the crackdown, they are now saying that they will support the development of internet consumer companies in China. And later in May, Li Keqiang came out to say that they must avoid an economic contraction in the second quarter. And this same message has also been reiterated by President Xi in a separate statement as well. So in both actions and words, it is very crystal clear that the Chinese government wants to move decisively this year in order to stabilize its economy. And we should also not forget that this year is a particularly important year for President Xi Jinping, because this year he is going to seek a historic third term as the president of China. So he will definitely want to go into his third term, showing that China's economy has made good progress under his leadership. So there are reasons to believe that the government will roll out more stimulus measures in order to achieve its GDP growth target for this year. And on the next slide, adding to our optimism is the fact that China has been emerging from its worst COVID-19 outbreak in almost 2 years. As we can see from the chart on your left, the number of COVID-19 infections has been trending down significantly in recent times. And because of that, the government has actually started to ease some of the very harsh COVID-19 lockdown measures that they have implemented over the past few months. So life in Beijing and Shanghai, it is now starting to return to normal. So if you look at the airport and also the seaport cargo volumes, so that is back at 90% of its pre-pandemic capacity. And workers are starting to return to office. Shopping malls are reopening, and also the government has started to reopen partially the public transportation system in China. And I've also included one additional chart on the right, which shows the volume of passengers taking the Shanghai Metro. And you can see that there has been a sharp increase in the number of passengers ever since the lockdowns were lifted. So there has been an easing of the COVID-19 measures over in China. But of course, on the next slide, I just wanted to say also that there are still risks when it comes to COVID, because the reality is that China is unlikely going to move away from its zero COVID policy. So what this means is that if there are going to be flare-ups in COVID-19 cases in China, then there is a possibility that China will reimpose some of these harsh measures that they have used over the past few months. And the implication is that economic growth will definitely take another hit. But having said that, I just wanted to say also that there are reasons also to be optimistic that zero COVID will not come at a huge expense to the economy. And I say that because the Chinese government, by now, they are well aware of the huge economic cost that comes along with this zero COVID policy. And we think that the urgency and the need to stimulate the economy is now so overwhelming that the government may be forced to try to find ways to accommodate these two objectives, or maybe be even forced to soften certain aspects of their zero COVID policy. And this is especially so after Li Keqiang actually summoned about 100,000 officials to an unprecedented meeting. And in this meeting, he actually expressed concerns about the slowdown and also to push for a faster easing of lockdowns. And this meeting is unprecedented because this is the first time ever that a top-level government official is addressing directly to the many different layers of government. And this is important because typically in China, policy transmission, it takes place across many different layers of government. So the message from the top, by the time it reaches the bottom, it could be misinterpreted or overly interpreted. It's just like how in the army, officer says wake up at 5:30, then down the chain of command, sergeant says 5:15. And then the men, we all wake up at 5 o'clock instead. So this is what is happening in China because zero COVID has been overly interpreted by a lot of the local government officials who don't want to get into trouble, which is why on the ground, you are seeing very harsh COVID-19 measures being implemented. And most of the times, these measures are implemented without regard for the economic cost that comes along with it, which is why Li Keqiang wanted to take this opportunity to tell all local government officials right now that a contraction in the second quarter must be avoided. And on top of that, you must better manage, you must better balance your COVID controls and economic growth. So this was the message that Li Keqiang had for the local governments in that particular meeting. So there are reasons to believe that certain aspects of the zero COVID policy measures will be softened. And this week, China actually shortened its quarantine period for international travelers. So the direction is very clear. The direction is very clear. They are not going to go back to the very harsh COVID-19 measures because of the huge economic cost that comes along with it. So there are reasons to believe that zero COVID will not come at the huge expense to its economy. And on the next slide, on top of that, we believe that investors have been overly pessimistic on the earnings outlook for Chinese companies, especially after a series of better than expected earnings results, including that from Alibaba and Baidu as well. And Baidu in particular actually reported an earnings decline of about 9% in its first quarter results, which in all honesty was not an impressive set of results, but because analysts have been so pessimistic on the earnings outlook of Baidu that the company ended up beating earnings expectations by a huge margin. And we can also see that the earnings estimates for China tech companies, as indicated on the blue line on this chart, the earnings estimates for Chinese companies, they have been downgraded very substantially this year. And this is in stark contrast to the S&P 500, where earnings estimates have actually been upgraded this year, despite the fact that there has been mounting economic risks at the global level. Analysts have been increasingly optimistic over the earnings outlook for US companies. But already, we are starting to see quite a lot of high-profile earnings misses in the US, including Walmart, Target, and also in the tech sector, we have also seen earnings misses from Amazon. Snap also issued a profit warning earlier this year as well. So clearly, it's two different markets. One with a lot of optimism, and the other one with a lot of pessimism being built into the markets. And on top of that, there has also been a stabilization in the earnings expectations of China tech companies. As you can see from this blue line, the earnings have actually been not downgraded in recent times, which means that analysts, they have stopped downgrading their forward earnings estimates for constituents within the Hang Seng Tech Index. So what this means is that if you look at the stabilization of earnings, the massive downgrade in earnings estimates, and also the huge sell-off that we have seen over the past 1 to 2 years, this means that perhaps a lot of the negative factors, a lot of the negative overhang that we have seen is already priced into the markets. And right now, there are also strong signs that China's crackdown on its big tech companies could finally be easing. As I've highlighted in my slides earlier, the government has been highlighting in various statements that they will support the development of the internet companies. And they have also been matching their words with tangible actions because they have done a couple of things, such as the recent approval of new gaming licenses, reports that the investigation in TT is about to be wrapped up. And earlier this year, they have also removed an audit barrier that involves US-listed Chinese stocks. So with an easing of all these regulations, there could be a potential rebound in Chinese companies in the years ahead. Next slide. And I think more importantly, I just wanted to say also that the valuations of Chinese equities right now, they are still very attractive, especially when you consider the fact that the MSCI China Index is currently trading at multi-year lows. So based on our in-house fair PE estimate that we have assigned to the Chinese equity market, we are actually projecting an upside of close to about 50% over the next few years for the Chinese equity market. Next slide. So if you want exposure to the Chinese equity market, then I have a couple of product recommendations. So on the active funds, our recommendation for active funds is actually the one by JP Morgan. And if you are a passive investor who prefer to just invest in ETFs, then our recommendation for that is actually the iShares Core MSCI China ETF. And of course, for those of you who just want to go straight into the areas that have been beaten down, the areas that are the most sensitive to policy changes, then you should just go straight for the China tech sector. And our recommendation for that is the iShares Hang Seng Tech ETF. Next slide. Okay, so just to wrap up, I just want to urge all investors here to keep faith in Chinese equities. I know it has been a painful journey for most of us here, or some of us here, who have been invested in Chinese equities over the past 1 to 2 years. The drop has been significant. But I just wanted to say also that the factors that have caused the huge sell-off in Chinese equities are starting to turn around. As I've mentioned in my previous slides, there is a turnaround, there is an easing of some of these negative factors that have caused the sell-off in Chinese equities. And it is our view that China has the ability to outperform its global peers over the next few years. And in fact, they have already started to outperform global equities in the month of June, as you can see from this table over here, at a time when global equities are selling off sharply. China's equity market rebounded strongly by more than 8%. And this also means that on a year-to-date basis, China is no longer the worst performing equity market in the world. And given that there has been a significant shift in its policy stance, we think that China definitely has the potential to outperform its peers over the next few years. So if there is ever a good time for you to buy Chinese stocks, that time is right now. So with that, I end my presentation today. Thank you so much for your attention, and I'll hand the time back to Gladys.